Hey everyone, welcome back. Today we're diving deep into the U.S. stock market, and I'm going to walk you through 5 of the most interesting growth stocks that investors are keeping a close eye on in 2025. Now, before we jump into the names, I want to set the stage because understanding the bigger picture is crucial. You see, it's not just about picking a stock that looks hot today, it's about understanding why it could grow over the next few years and how it fits into the broader economy. So, let's start with the state of the U.S. economy. We've seen a lot of ups and downs over the past few years. Interest rates, inflation, and global events have all played a huge role in shaping where the stock market is today. The Federal Reserve has been navigating a tricky balance, keeping inflation in check without slowing down economic growth too much. For investors, this matters because interest rates influence how companies borrow money to grow and how attractive stocks are compared to other investments like bonds. Historically, periods of rising rates can be challenging for high-growth stocks because their valuations are often based on earnings expected several years down the line. But here's the thing, even in these environments, certain companies continue to shine because their products and services are so essential that demand doesn't slow down. These are the companies we're going to focus on today. Now, let's talk a little bit about what makes a growth stock a growth stock. In simple terms, these are companies that aren't just making money, they're expanding rapidly, whether through sales, market share, or innovation. They often reinvest profits into research and development, new products, or acquisitions, rather than paying big dividends. The idea is that your investment grows as the company grows. Of course, the flip side is that these companies can be volatile. If expectations aren't met, the stock can swing significantly. Another important factor is diversification. No matter how exciting a stock seems, it's never a good idea to put all your eggs in one basket. Well, talk about 5 different companies today, spanning semiconductors, cloud computing, e-commerce, digital advertising, and pharmaceuticals. Each one operates in a different sector, which is great for spreading risk. You get exposure to different growth engines in the economy rather than betting everything on a single trend. Speaking of trends, 2025 is shaping up to be a fascinating year for investors. Artificial intelligence is taking off in a big way, impacting everything from chips in data centers to software applications in offices. Cloud computing is more important than ever, supporting everything from remote work to AI model training. And in healthcare, biotech companies are pushing the boundaries of medicine with innovative treatments for diabetes, obesity, and more. So even if the market is volatile, these sectors have compelling tailwinds. Now, I also want to emphasize something important. No stock is guaranteed to pump. The market can be unpredictable, and even the best companies face risk from global economic slowdowns to regulatory changes and unexpected competition. That's why we'll focus on understanding why these companies are interesting, what drives their growth, and what risks to watch, rather than making promises about overnight gains. With all that context in mind, we're ready to start exploring our first company. Each of the 5 stocks we're going to discuss has a unique story, strong fundamentals, and exciting potential in its respective sector. We'll go in depth on what makes them tick, how they've performed recently, what analysts are saying, and why investors are watching them closely in 2025. Before we jump in, let's take a quick look at some key trends shaping the market today. Tech is still king. The semiconductor boom and AI adoption are driving enormous demand. Companies like Nvidia are leading the charge here. Cloud adoption keeps accelerating. Businesses are moving critical workloads to the cloud, benefiting Microsoft, Amazon, and Google. Healthcare innovation is booming. New drug approvals, biotech pipelines, and personalized medicine are creating growth opportunities for companies like Eli Lilly. Regulation is always a factor. Antitrust laws, FDA approvals, and global trade tensions can have a big impact on these companies, so staying informed is key. Investor sentiment matters. Even strong fundamentals can be overshadowed by fear or euphoria in the market. Understanding market psychology is almost as important as understanding the companies themselves. So, in a nutshell, 2025 is a year where smart, informed investing can really pay off for points. You know where to look and how to manage your risks. And that's exactly what we're going to do in this series. We'll break down each stock in detail, discuss their growth drivers, examine risks, and see what makes them stand out. By the end, you'll have a clear picture of why these 5 companies are on so many investors' radar this year. Alright, with the scene set, let's dive into our first stock, Nvidia, the AI powerhouse that has everyone talking. We'll explore why this company is at the heart of one of the fastest growing sectors in the world, what its financials look like, and why analysts are so optimistic about its future. Stock 1, Nvidia, the AI powerhouse. Alright, let's start with Nvidia, the company that has become almost synonymous with artificial intelligence and advanced graphics. If you've been paying attention to the tech world over the last few years, you've probably heard about Nvidia's chips powering everything from gaming rigs to massive AI models that train language and image recognition systems. But there's a lot more to this company than just really good graphics cards. Nvidia's story is one of vision, innovation, and timing. The company started in the 1990s focusing on graphics processing units, or GPUs, primarily for gaming. But over time, it realized that its technology had a much broader application. GPUs are excellent at parallel processing, which makes them perfect for AI computations. That pivot positioned Nvidia at the center of a revolution that most investors are just beginning to understand fully. Financially, Nvidia has been nothing short of spectacular. The company has seen explosive revenue growth over the last few years, largely driven by data center demand and AI workloads. Their earnings reports have consistently beaten analyst expectations, showing not only strong top-line growth but also impressive margins. What's particularly fascinating is that Nvidia has maintained profitability even while aggressively investing in research and development. This is not a company resting on its laurels, it's continually pushing forward. One of Nvidia's biggest strengths is its diverse product ecosystem. While gaming remains an important segment, data centers now contribute a massive portion of revenue, and the automotive division is developing AI-driven systems for self-driving cars. This diversification is critical because it means Nvidia isn't relying on a single market to sustain its growth. When one sector slows, others can compensate, giving the company resilience in an otherwise volatile industry. Another competitive advantage that often gets overlooked is the software ecosystem Nvidia has built around its hardware, particularly the CUDA platform. CUDA is a parallel computing platform and programming model that allows developers to write software that runs efficiently on Nvidia chips. This has created a sort of developer lock-in because switching away from Nvidia hardware can be costly for software engineers who rely on CUDA. In other words, it's not just the hardware that's valuable, the ecosystem. Now, let's talk about growth drivers, because this is where things get really exciting. AI adoption is accelerating across industries, and Nvidia is at the heart of it. Think of every AI chatbot, image generator, or large-scale recommendation system running on GPU's Nvidia hardware. The demand for AI-specific chips has skyrocketed, and Nvidia is in the perfect position to capitalize. But it doesn't stop there. Cloud computing is another major growth driver. Cloud providers like Amazon Web Services, Microsoft Azure, and Google Cloud all rely on Nvidia chips to power AI workloads. Every time a company trains a large AI model, it's driving revenue back to Nvidia. The company's automotive segment is also worth mentioning. Self-driving technology is still in its early stages, but Nvidia's DIVE platform is being used by many car manufacturers and tech startups developing autonomous vehicles. While it's not the largest revenue contributor yet, it represents a massive long-term opportunity, especially as AI adoption in vehicles accelerates over the next decade. Of course, no company is without risks, and Nvidia has its fair share. One of the biggest is geopolitical risk, particularly export restrictions. The U.S. government has placed limits on selling some advanced chips to certain countries, which could impact revenue if the situation escalates. There's also competition from companies like AMD and Intel, who are investing heavily in AI and high-performance computing. While Nvidia currently has a technological edge, the market is always evolving. Then there's the natural cyclicality of the semiconductor industry. Chip demand can fluctuate based on economic conditions, consumer spending, and supply chain dynamics. Nvidia has navigated these cycles well, but it's something investors need to be aware of. Short-term volatility is almost guaranteed, even for a company with such a strong long-term trajectory. Analyst sentiment around Nvidia has been overwhelmingly positive. Most major institutions maintained by or strong by ratings and price targets have been rising consistently. Investors love its growth potential, technological leadership, and strong balance sheet. In fact, institutional ownership is very high, which often indicates that large, sophisticated investors are confident in the company's long-term prospects. Looking at the financials more closely, Nvidia has strong profit margins, cash flow, and return on equity. The company isn't just growing, it's growing efficiently. Their gross margins are consistently above industry averages, thanks to the premium pricing of their chips and enterprise solutions. Operating cash flow is healthy, giving the company flexibility to invest in R&D, make strategic acquisitions, or weather economic downturns without issue. Another interesting point is Nvidia's commitment to innovation. They are not only refining existing products but also developing entirely new technologies. For example, their work in AI accelerators and data center solutions shows forward-thinking where the industry is going, rather than reacting to it. This proactive approach is one of the reasons Nvidia continues to outperform peers in a highly competitive market. But perhaps the most exciting aspect for investors is Nvidia's position in the AI revolution. Large-scale AI adoption isn't just a trend, it's a paradigm shift, and Nvidia is effectively the engine powering it. From machine learning to autonomous systems, AI workloads are expanding rapidly, and the demand for high-performance chips is expected to grow exponentially over the next several years. If AI continues its current trajectory, Nvidia is set to benefit tremendously. Now, a lot of people ask, isn't Nvidia too expensive? Yes, by traditional valuation metrics like P ratios, Nvidia might look pricey. But growth investors often look beyond simple ratios and focus on the company's future cash flows and market position. When a company is growing at this scale, paying a premium can sometimes make sense, provided you're comfortable with the volatility. Finally, let's wrap up Nvidia's story with a forward-looking perspective. While nothing in the market is guaranteed, Nvidia's dominant position in AI, diversified product lines, strong financials, and innovative ecosystem make it one of the most compelling growth stories in the U.S. stock market today. Investors should be aware of risk-cyclical demand, competition, and geopolitics. For those looking at long-term potential, Nvidia remains a name worth understanding and monitoring closely. In short, Nvidia isn't just a chip company, it's the company powering the AI-driven future, and that's why it has captured the attention of investors around the globe. From gaming to data centers to autonomous vehicles, Nvidia's technology is everywhere, and its growth story is still unfolding. Stock to Microsoft MSFT, the cloud and productivity powerhouse. Now, let's move on to Microsoft, a company that, despite being over 4 decades old, continues to reinvent itself and dominate multiple industries. When most people think of Microsoft, they picture Windows and Office. But today, Microsoft is so much more than just software. It's a global powerhouse in cloud computing, AI, gaming, professional networking, and enterprise solutions. Microsoft's story is one of adaptation and foresight. While some tech giants struggled to pivot in the post-PC era, Microsoft doubled down on cloud computing and subscription-based software. Today, its Azure cloud platform is one of the fastest-growing segments, rivaling Amazon Web Services for global market share. Azure has become the backbone for countless businesses, providing infrastructure, AI tools, and enterprise solutions that companies increasingly rely on. Financially, Microsoft has been incredibly strong. The company posts steady revenue growth, impressive operating margins, and consistently high profits, all while investing heavily in research and development. Analysts love Microsoft not just because it grows, but because it grows efficiently. Its combination of recurring revenue from subscriptions, cloud services, and enterprise software makes its financials very predictable compared to more cyclical tech companies. One of Microsoft's biggest strengths is its diversification. While Azure drives growth, the company also earns significant revenue from Office 365 subscriptions, LinkedIn, GitHub, and its gaming division, which includes box hardware and a huge library of software titles. This multi-pronged approach allows Microsoft to capture value across multiple sectors, reducing dependency on any single revenue stream. Another standout feature is Microsoft's integration of artificial intelligence across its platforms. With the launch of Copilot in Office and Teams, Microsoft is embedding AI into the software millions of people use every day. It's not just a novelty, it's changing the way businesses operate. And with its strategic partnership and investment in OpenAI, Microsoft has positioned itself as a key player in generative AI, providing infrastructure and applications for businesses, developers, and researchers. Azure's growth is also fueled by the rapid adoption of cloud computing worldwide. Enterprises of all sizes are moving workloads to the cloud for flexibility, cost efficiency, and scalability. Microsoft's global data center footprint, coupled with strong enterprise relationships, gives it an advantage in this competitive space. And unlike some competitors, Microsoft has a proven track record of keeping large organizations happy, which is crucial for long-term growth. Gaming is another pillar that shouldn't be overlooked. Microsoft's Xbox ecosystem, coupled with its Xbox Game Pass subscription, provides recurring revenue while also giving the company a platform to explore cloud gaming. Gaming might seem tangential to investors focused on AI and cloud, but it's actually a high-margin, recurring business that adds stability and diversification. From a financial perspective, Microsoft is rock solid. It boasts strong cash flow, a massive cash reserve, and low debt levels, giving it flexibility to make strategic acquisitions, buy back stock, or invest in future technologies. Its ability to generate consistent profits while funding innovation makes it one of the safest big tech companies for long-term growth investors. Of course, no company is without risks. Microsoft faces regulatory scrutiny, particularly in Europe and the U.S., over issues ranging from competition to privacy. Cloud and AI are competitive markets, with Amazon, Google, and other tech giants vying for market share. Currency fluctuations and geopolitical tensions can also affect multinational companies like Microsoft. But despite these headwinds, the company has consistently demonstrated resilience. Analysts are bullish on Microsoft, and it's easy to see why. The consensus among Wall Street professionals is overwhelmingly positive, with most maintaining buy or strong buy ratings. Investors appreciate Microsoft's predictable cash flow, diversified business model, and long-term growth potential. Institutional ownership is high, reflecting confidence among sophisticated investors who understand the company's strategic advantages. Another reason Microsoft stands out is its focus on enterprise solutions beyond cloud. Products like Teams, Dynamics 365, and LinkedIn give the company multiple touchpoints in business operations, creating sticky relationships that are hard for competitors to disrupt. Once a company integrates Microsoft tools into its workflow, switching costs are high. This is a classic example of a durable competitive advantage. Let's talk about growth drivers in more detail. First, Azure and cloud services continue to be the engine of expansion, with AI workloads accelerating demand for high-performance computing. Second, the integration of AI across Office, Teams, and Dynamics 365 improves productivity and drives subscription growth. Third, strategic acquisitions, like Nuance Communications and Healthcare AI, expand Microsoft's addressable market and open up new opportunities. On the financial side, Microsoft's operating margins are consistently high thanks to the scalability of cloud and software solutions. Gross margins remain above industry averages, and the company generates massive free cash flow, which it can reinvest in growth or return to shareholders. This makes Microsoft not just a growth story but also a company with strong fundamentals. One more interesting angle is Microsoft's commitment to long-term innovation. The company invests heavily in quantum computing, cybersecurity, AI research, and mixed reality platforms like HoloLens. These are not immediate revenue drivers, but they position Microsoft to remain a tech leader for decades to come. Few companies have the resources, vision, and execution capability to maintain such a diverse innovation pipeline. Now, let's talk about valuation, because that's always on investors' minds. Microsoft is not the cheapest stock in the market. P ratios might look high compared to traditional companies, but for growth investors, this reflects the premium you pay for stability, recurring revenue, and long-term potential. It's about quality at a reasonable growth-adjusted price rather than a bargain basement pick. Finally, let's consider Microsoft in a broader market context. The company is a perfect example of how mature tech firms can continue to grow in a dynamic market. It combines the best of both worlds: stable, predictable cash flow from established products, and high-growth opportunities through Azure, AI, and enterprise software. This makes it appealing to both conservative and growth-oriented investors. In short, Microsoft is more than just a software company. It's a diversified, innovation-driven tech giant. Its leadership in cloud computing, integration of AI, gaming ecosystem, and strong financial health make it one of the most compelling names in the U.S. stock market today. While there are risk-regulatory, competitive, and global companies, consistent execution, massive cash reserves, and vision for the future provide a level of confidence that's rare in tech. For anyone looking at growth stocks in 2025, Microsoft represents stability and opportunity rolled into one. It's a stock that not only participates in the AI and cloud revolution but also generates real, consistent value along the way. And that combination is exactly why investors continue to watch it so closely. Stock 3: Amazon AMZN, e-commerce and cloud giant. Alright, now let's talk about Amazon, one of the most iconic companies of our time. When Jeff Bezos founded Amazon in the 1990s, it started as an online bookstore. Fast forward to 2025, and Amazon is a global e-commerce powerhouse, a cloud computing leader, and a tech innovator touching almost every aspect of modern life. It's a company that has evolved, adapted, and continuously disrupted industries, which is exactly why investors are so fascinated by it. At its core, Amazon is a logistics and technology company disguised as a retailer. Sure, it sells products online, but the real engine of its growth is its infrastructure, distribution networks, cloud platforms, AI-driven recommendations, and a global customer base. The company has turned logistical excellence into a competitive advantage, allowing it to offer services like same-day delivery, massive product variety, and an unmatched shopping experience. Financially, Amazon has had an interesting journey. Its e-commerce segment has historically operated on thin margins, but the cloud business Amazon Web Services (AWS) has been the real profit engine. AWS provides cloud computing services to millions of businesses worldwide and has consistently contributed a significant portion of Amazon's operating income. Even as Amazon reinvests heavily in logistics, technology, and new ventures, AWS ensures that the company maintains robust profitability. Diversification is key to Amazon's success. The company isn't just selling goods online, it's branching into cloud computing, advertising, subscription services like Prime, and emerging sectors such as healthcare and robotics. This diversification allows Amazon to capture revenue from multiple sources, providing stability even when one business segment faces challenges. One of Amazon's most important growth drivers is AWS. The cloud market is expanding rapidly, with businesses of all sizes moving workloads off premises and into cloud infrastructure. Amazon has an established first-mover advantage here, and its cloud services portfolio from AI tools to storage and security solutions clients deeply integrated. Many companies rely on AWS not just for cost savings but because Amazon provides scalable, reliable infrastructure that is difficult to replicate. E-commerce remains another critical pillar. While competition from Walmart, Alibaba, and Shopify continues, Amazon's scale, data analytics, and logistics capabilities make it extremely hard for rivals to match the customer experience. AI-driven recommendation engines, smart pricing strategies, and a vast network of fulfillment centers allow Amazon to maintain a dominant position in online retail globally. Subscription services, particularly Amazon Prime, also play a crucial role in growth. Prime not only generates recurring revenue but also builds customer loyalty, encouraging frequent purchases and driving engagement across Amazon's ecosystem. Services like Prime Video and Amazon Music further strengthen the brand and keep customers within the Amazon environment. Healthcare is another frontier that Amazon is exploring aggressively. With acquisitions like PillPack and initiatives in telehealth, Amazon is aiming to disrupt traditional healthcare delivery. While it's early days, the potential here is massive. Healthcare is one of the largest sectors in the U.S. economy, and any company that can streamline delivery, reduce costs, or improve patient outcomes has enormous upside. Advertising is often an overlooked segment of Amazon's business. The company's e-commerce platform provides highly targeted ad placement opportunities for brands. As Amazon continues to collect and analyze customer data, advertising revenue grows with minimal incremental costs, making it a high-margin, rapidly expanding revenue stream. Of course, no story is complete without considering risks. Amazon faces several headwinds, including regulatory scrutiny, labor costs, and supply chain challenges. Governments around the world are closely watching Amazon's market dominance, and potential antitrust actions could impact operations. Labor costs, especially in logistics and fulfillment centers, are also significant and can affect margins. Additionally, global supply chain disruptions or rising shipping costs can create pressure on profits. Competition is another factor to consider. While Amazon is dominant, it faces serious rivals in cloud computing, e-commerce, and digital advertising. Companies like Microsoft, Google, Alibaba, and Walmart are all vying for market share. Amazon has consistently adapted to competition, but investors should remember that even giants face challenges in highly competitive markets. Analyst sentiment around Amazon is generally positive, with a majority rating it as a buy or strong buy. Analysts often cite AWS growth, Prime membership strength, and expansion into new sectors as reasons for optimism. Institutional investors also hold significant positions, signaling confidence in the company's long-term strategy. Looking at financials, Amazon has strong revenue growth, although margins in retail can fluctuate. AWS consistently delivers high margins and cash flow, allowing Amazon to fund innovation, acquisitions, and expansion. The company's balance sheet is solid, providing flexibility to invest in emerging technologies like AI, robotics, and healthcare. One of the most exciting aspects of Amazon is its commitment to innovation. The company is not content with maintaining the status quo. From AI-powered logistics and smart warehouses to autonomous delivery vehicles and drone programs, Amazon continually explores technologies that could redefine industries. Even though some initiatives may take years to bear fruit, the potential upside is enormous. Valuation is always a topic of debate with Amazon. Some investors think the stock is expensive, especially when looking at the price-to-earnings ratio. But growth investors often focus on the company's long-term potential, cash flow generation, and market dominance. Paying a premium today may be justified if Amazon continues to expand into new sectors and maintain leadership in cloud and e-commerce. Amazon also benefits from network effects. the more people shop on Amazon, the more data it collects, which improves recommendations, inventory planning, and advertising effectiveness. This virtuous cycle reinforces customer loyalty and creates barriers to entry for competitors. In terms of long-term outlook, Amazon has several catalysts that could doctor growth over the next decade. AI integration into AWS, expansion in healthcare, continued e-commerce dominance, and global logistics improvements all position the company for multi-year growth. While short-term volatility is likely, the company's diverse business lines provide multiple avenues for sustained success. In summary, Amazon isn't just a retailer or a cloud provider, it's a technology-driven ecosystem company. It combines logistics, cloud infrastructure, AI, subscription services, advertising, and healthcare into a single, sprawling platform that touches millions of consumers and businesses every day. Its scale, innovation, and market dominance make it one of the most compelling U.S. growth stocks to watch in 2025. For investors, the takeaway is clear: Amazon is a long-term growth story with multiple engines of expansion. While risks exist, the company's ability to innovate, adapt, and dominate multiple markets makes it a name worth monitoring closely. From e-commerce to AI-powered cloud services, Amazon continues to shape the future of global business, and that's why it remains a top pick in the U.S. stock market today.